Here we go. Our first lesson together. Lesson 1 walkthrough. This is about owner's equity, corporate owner's equity. For those of you new to accounting, this is going to seem somewhat odd to begin with, but just remember this is an accountant's way of telling the financial story of a business, and we do that with journal entries. So we have scenarios and we write them down and create accounts to hold the costs and the dollars. So we're going to start with, first of all, we've got 65 points in the lesson, and that will be converted up to 100 points before we're done. Again, the question and then an answer template. And this actually should read 1. Just didn't get it changed. So each assignment has a template assigned to it. In this one, we're looking at they authorized 10,000 shares of common stock to be sold. They issued or sold 8,000 shares, and each share cost 50 cents. So if you multiply 8,000 times 50, you'll end up with $4,000. But on the market, people paid more for it. So, and it looks like they must have paid something like 97, 98 cents. I'm not quite sure exactly. So there was a total of $7,950 paid for these 8,000 shares. But when we're looking at stock that has par, you see this little par right there? It says par. That means that is their cost. That's their bench line. In theory, okay? Par doesn't really mean much other than it gives a benchmark of how to define the stock. So when we record this, when they actually give us the cash, we would have to record that full amount of $79.50 and separate out the two different the distinctions between par value and what was paid in excess of par. So that would be $4,000 for the common stock and $39.50 for what was paid in above that. And that is how it's listed on the balance sheet. Is it's going to be separated out between the two. This is my par, this is what's paid in excess of. So that is how you record purchasing a stock. If there had been if they just paid the 50 cents par, we wouldn't have had this last entry. 3 entries like this is called a compound entry. So that is question 1. Now this question's just a little bit different. We're going to create, this is your equity section of the balance sheet. Now we're going to create one of those. And literally, this says this is the title. This is what it is, and it wants to know what common stock is. Well, if I come up here, I see common stock, $2 par, issued $80,000. This is all in dollars. So common stock is listed here at $80,000. What's the additional paid in capital? Well, where do they have that listed at? That's $16,800. Kind of get the idea? Now we need to add those two together, which is going to be $96,800. And retained earnings is another part of equity. And retained earnings are previous net income that hasn't been distributed to the stockholders or hasn't been removed from the equity section. And it looks like our retained earnings is $17,000. Now, I left this $113,800 in for a check number so that we could add $96,800 and $17,000 and know that we had the right number. So now we know how to record, and we know how to report equity. The next question, which is number 3, is doing the other thing that investors really like, and that is paying dividends. And in this case, we have 2 different kinds of stock. We have preferred stock, which always gets its dividend first, and its dividend is paid on the par value, and usually a percentage of the par value. And we have common stock, which is usually paid per share. So as we look at this, we've got 2 calculations. The first calculation is for par, or is for the preferred stock. If I do that calculation, 2% of $110,000 is, oh my goodness, I have to do that in my head, that'll hurt, is $2,200. Is that correct? Somehow that doesn't look, it might be. So, preferred stock is getting $2,200. We're just going to put that down here. And in addition to that, we are doing a common stock dividend, which is $1 per share, and we have 65,000 shares out. So that's 65,000. Now we have to add those 2 together to find out how much we owe for our dividends. Now, you notice we just declared them. When you declare them, you only set up a payable. You don't pay out the dividends yet. So if I add these 2 together, I must come up with $67,500, That is how much I will pay out in the future. Now, dividends are always deducted from retained earnings. So that's how we record a declaration of dividends. You make the payable and you subtract them out of retained earnings. The final is when you pay them, and that's kind of already set everything up. Now we credit cash in a journal entry, and we debit the dividends payable, which empties out the dividends payable account and subtracts it from cash. So now what we've learned so far is how to record stock, how to report it, and then how to pay out dividends. Now this one, we're going to create a balance sheet. And a balance sheet is really a lot of fun, especially this kind, because we don't really have to calculate the numbers. All we have to do is what I call a plug and chug. Let's see, I actually give you a template down here to help you. So what we're going to do, a balance sheet reflects assets and liabilities and owner's equity. It reflects the financial position of the company and records all of its assets and all of the money that the company may own. And then what's left over is the equity that belongs to the stockholders or shareholders. So what we want to do is, I'm just going to drag this. Maybe I can drag this down. Let's see. Okay, so yeah, this is better. We have it all in one place. So current asset is an asset that is going to be used within a year. It's something that's very liquid. Current assets are usually cash, accounts receivable. What else do we have up there that's going prepaid? Anything prepaid is usually going to be within a year. Inventory would probably, yeah, definitely would be. So we're looking at putting inventory up there. So I think that's all of our current assets. So then we will pull down the numbers here, and they should add up to $257,000 because I left that check figure in there. So once you pull those off, mark them off so you don't get them confused. We have our current assets. Now we want to look at property, plant, and equipment, and that's net. That means without the depreciation. There should be, yes, there is. So that's $282,000. And finally, we look at intangibles. And intangibles are things that aren't concrete, such as patents, goodwill, things of that nature that are copyrights. So if I look up here, I think the only intangible I have is the goodwill. And its quantity would go here. Now, as I add all of these up, we seriously hope that that comes up to $601,000 because that is those are your total assets. So once you get your assets taken care of, you move over to your liabilities, and you're going to do the same thing. We have current liabilities, and current liabilities are bills that are due within a year. The first one is accounts payable, and you will find that right here. So that quantity would go there. We have dividends payable would go in there, because that's definitely going to be paid within the year, probably within the month, quite honestly. And you have something called accrued liabilities, which are more than likely payroll that has to be paid within the week. So those are your current liabilities. If you put your totals in here, they should add up to $56,000. There's a long-term note, and whenever you see long-term, that means that that is a non-current. So that amount, the $105,000, would go here. If I add these two together, I should come up with $161,000. Now, I gave you a lot of information about the paid-in capital because it's very confusing for you. So you should be able to pull those numbers off of up here, plug them in here. When you get done, they should come up to $320,000. And you should have a total owner's equity, a stockholder's equity then of $440,000. That added to your liabilities should match your assets at $601,000. And that is a very quick balance sheet. And actually it's kind of complex because of this. This is usually the most complex part of a balance sheet. So then they ask one more question. They ask, and this calculation is in the book, the rate of return on common stock equity. Now, what are we talking about? So you have stockholders' equity here, correct? And that includes retained earnings. We're looking at just the stockholders' equity for the year. So that's going to be $320,000. They give us some numbers here from the prior year. And as we look at that, we see that last year their equity was $306,000. So keep that number in mind. So let's go down here, and what is our owner's equity? We've got this in stocks. We've got this including our retained earnings at $440,000. But preferred stocks are not included in true owner's equity because they can come and go. They're not a common stockholder and they don't have voting rights. So whatever that amount is, let's see, preferred stock is $50,000. So this $50,000 here has to be deducted from the $440,000 to get our true owner's equity for this year. So keep that in mind here. So now, net income minus preferred dividends divided by the average common stock equity. Now that is a big mouthful. So, how do we find that? Any clues? Let's kind of think about it. Does it tell us what the, oh, there it is. Net income is $43,000. Okay, so we have one number. So let's kind of calculate this out. I have $43,000 in net income. I have a beginning owner's equity of $306. I have an ending owner's equity of $390. Remember, we took out the preferred. Now, do I have enough information to do what I want? What were my preferred dividends? That's something that's missing here, right? Does it tell us preferred dividends? It does. It implies preferred dividends, and that is, it doesn't really give you a number, 50,000. And if they paid dividends, it would have been 4% of that, and we're going to assume that they did pay dividends. So 4% of 50,000 is, not wanting to confuse you, I definitely will use a calculator to make sure I have it right, $2,000. So now, can we do this? I think so. Look at this. You've got the rate of return is net income minus preferred dividends divided by average common stock. So we've got all the numbers. I think you can do that. So take your net income, subtract the preferred dividends of $2,000, divide it by the average of these two, the beginning and the ending, and that should give you the rate of return. Now you could also do one on the rate of return of assets, which would add one other number, which is the interest expense, which is also a given. So you should have enough information now to figure that out. What we're looking for, though, is only the common stock. We probably, I just wanted you to know that you could do a rate of return on the assets also. So how would I do that? I would take net income minus the preferred dividends of $2,000, find an average of these two, and divide it into the 43 minus the 2,000. That would give you an answer of 11.8%. Now you want to show me how you did that and give me calculations. And then you want to look at that and say, is that a good return? And then give me a reasoning for that. And that concludes Lesson 1. Good luck. All the points have been assigned. As soon as you turn it in, I'll get it graded. Have a great day, alrighty?